The Reserve Bank's Monetary Policy Committee meets in the background of challenging global cues, with US yields and crude oil surging. Now, as always, Citizen Monetary Policy Committee of CNBC-TV18 meets ahead of the Reserve Bank's MPC to deliberate on issues confronting the policymakers. I have with me my members, Chairman of our committee, Dr. Pronab Sen, and the members, Sajjid Chinoy of JPM, Samiran Chakrabarty of Citibank, Soumyo Ghosh of State Bank of India, and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much for your time. Okay, since I started with the global backdrop, let me make that the first question. Sajjid, that's to you. Jamie Dimon has famously just said, are we prepared for 7% US yields? Now, US yields have already climbed rapidly in the last few weeks. Can you parse the global environment that the MPC is confronted with?
I think, Latha, the global environment has become much more challenging compared to when the MPC last met 2 months ago. Some of the genesis of this is just the sheer strength and resilience of the US economy. Remember, everyone was expecting some kind of slowing of the US economy in the second half of this year. Guess what? The third quarter GDP is tracking 3.5%, much above the 2% that we've seen in the first half of the year. So this is now beyond resilience. This is full-blown strength. And this is what's going to keep the Fed nervous and cautious, that even though there has been some disinflation, core disinflation in recent months, you can never be sure that this is going to endure, given the strength of the US economy. And that's why the Fed has very modest rate cuts in 2024 and 25. And once the market has come to figure that out, rates have gone up and we're in this high for long environment, which is why the US 10-year yield is close to 4.5%. But that's only one of the trifecta. The second element is US exceptionalism, that you've got US strength, which is juxtaposed with European growth stalling. Europe this year will grow at less than 1%. And that has meant that the dollar continues to strengthen and is at a 6-month high at the moment. And the third element is, as if this combination of higher for longer US rates and a stronger dollar is not enough, you've got OPEC cutting supply, so crude prices are above 90. So this is a more challenging global environment characterized by higher rates, a stronger dollar, higher crude prices. It's a mini rerun of what happened in 2022. Not of the same magnitude, but directionally the same. And therefore, emerging markets in general will have to double down again on macroeconomic stability.
Okay, got that. Soumyo, that's the global scenario. Looks a little inflationary compared to what perhaps the MPC was prepared for. Do you want to add anything to that? But more importantly, our inflation trajectory, August was clearly lower than what the market was prepared for. Is there even a chance that Reserve Bank will lower the CPI projection from the current 5.4?
Thank you, Latha. I think regarding the first point, I don't think the Reserve Bank is going to lower the CPI inflation yet, because it needs to keep the pedal firmly on inflation control, as it has been saying, and I don't see any change in the communication or stance in the policy. Now, the important point to know, even though the September inflation number could actually come significantly lower because of base effects and other things. But regarding your first point on the global economy, I think we are actually currently in interesting times. The JP Morgan has recently added India, is going to add India to the bond index. So actually, everything opens up a Pandora's box. If I just jog our memory 30 years back, in March 1990, in September 2000, in October 2007, the Fed actually had made changes and the economy was very strong. And look what happened after that. My simple conjecture is that the economy may be very strong, as you correctly pointed the US economy, but a scenario of a soft landing as of today, or a hard landing, or many words are being thrown, or a recession, I think this is very difficult to judge at this point of view. The most important point is that we are living in an era of uncertainty, so we don't know what is going to happen next. But one simple data point which could actually make the thing a little more make the things look a little more difficult for the global economy is that I think a lot of these if Fed is unlikely to cut rates very aggressively in 2020, what it has clearly said, that means that it will be higher for longer. That means the reset of these loans, which these people have taken at fixed rates, that is unlikely to happen in 2024-25. If that doesn't happen, that will add to significant trillions of debt to the household, and that will continue. So in my sense, the jury is still out whether the economy is stronger, or it will be a soft landing, or it will be something else, maybe 1 or 2 years down the line.
Oh, yes, the new word seems to be even no landing, that we go on with the confusion. But yeah, Soumyo, you are raising some red flags on growth. Not very fashionable when the US growth is so strong. But let me toss that to Sonal. Sonal, you have always worried that India's growth will falter. But numbers are still decent when you look at, the last GDP number, or the tax collections, or the power consumption, or auto sales. What's your sense? Does the Reserve Bank have to tinker with the growth number of 6.5 at all? They may even give us a forecast for next year. What is the growth scenario that MPC is confronted with?
Yeah, Latha, I think as is the case in US, I think India as well, the domestic demand side in particular has been more resilient than expected, at least on our end. I think the RBI is likely to retain its 6.5% growth projection for this year, and they might in fact pencil in a similar number of around 6.5% even for FY25. The Q1 numbers at 7.8 were largely in line with the nowcasting, and the momentum in the second quarter currently is showing a higher momentum, even though the YOY will come down. So from the RBI's perspective, the view on strength in domestic demand will likely remain the baseline. I would, though, question the sustainability of the growth outlook. I think one, I would say the distribution of rains and its impact on food production does question the extent of strength one should be building in on both agriculture on the supply side and rural consumption on the demand side. Second, I think public capex, we've seen significant front-loading of public capex, and that has been a big growth contributor. I think going forward, particularly after December, our view is there will be some scaling back on the capex numbers. And third, I think in terms of private investment, our view is it is not yet broad-based. And in light of the global uncertainty and elections lined up here in India, we don't think there's going to be a material takeoff yet. So I think things do look good, but in terms of their sustainability into next calendar year and FY25, to our mind, is still questionable.
Mm-hmm. Well, if growth is as good, then perhaps the excuse to cut is also moving away. Of course, there are other reasons why they cannot. Samiran, the bond index has already been referred to. I wanted to know whether that is material at all for the MPC in any way. And more importantly, how should they behave when you are confronted with this kind of a global environment where rates are so high?
So, Latha, the actual flows on this bond index are going to not so much be a factor in FY24. It's more a FY25 issue. At best, some active flows can come in end of FY24. But the bigger thing from a monetary policy perspective to think about is that whether this is going to now make our monetary policy more connected with the rest of the world. Okay. Earlier, we could easily follow an independent monetary policy because the total investment into Indian government bonds was just 1.5%. And similarly, on fiscal side, now there would be more market discipline on the fiscal behavior. So both these things from a macro stability perspective are good, but they will put some shackles around how fiscal and monetary policy can be governed. On top of it, the big challenge would be that because this will be a one-time inflow, how to manage the liquidity considerations coming out of this. At that point of time, how much sterilization would be needed? between the different instruments of sterilization, OMO sales, MSS bond issuance, CRR or FX swaps, which one would be preferred, which will have least unintended consequences on markets. I think we'll have to grapple with all these issues when it comes. The immediate objective should be to reduce volatility in rates and FX at the time of these flows, because we all understand that this is a one-time phenomenon. Once the index weight of 10% is reached, incrementally every year, the amount of flows will be minimal. So from that perspective, if we can manage this period well, then it's a good thing to have.
You know what I'm taking away from what you said? That we have to be more responsible. As you say, both for the fisc and for RBI, there is a big tail that can wag the dog, so to speak. So, you can't take liberties with the fisc. So that is the question to you, Dr. Sen. We have an election round the corner, and, typically you could see revenue expenditure go up. And after all, fuel and food is an issue. So even without an election, there could have to be higher revenue expenditure. Do you think the MPC and the RBI have to keep that behind their head? In their process of achieving that 4%, will the fisc become a problem? Is that a factor?
Almost certainly. Look, at the moment, I think we should have our eyes firmly trained on the elections and the build up to the elections. And it's not just a question of, how the fisc behaves. Whether there's going to be more revenue expenditure. There may not be, but there may be a lot of announcements which could have very, very strong expectationary effects. So, but the other thing we have to keep in mind that Indian elections have always been preceded by a huge amount of private spending by the political party. So there is an unnatural boost to demand that happens in roughly 4 months prior to the elections. We are just about coming into that window now. Another month and we'll be there. And that's something the RBI has to keep in mind, because that is going to happen. Which means, and remember, RBI is going to be in a purely reactive situation there. Yes. So they have to figure out what the likely implications are, given what the global developments have been, and how do you best adjust to it? Do you need to take proactive steps, or do you wait until it starts happening and then try and pick up the pieces as you go along? This is not an easy call. And if now we have a situation where there is a sudden influx of external funds into the bond market, that just makes RBI's job that much tougher.
Okay, I thought this was just a more of the same policy, but actually quite a few problems, isn't it? Crude unnaturally high, or higher than what it was when they previously met. US yields higher, more money likely to come and create a liquidity problem. And fisc could be a problem. So will the liquidity tool be used much more by the RBI? That question to my guests after this break.
From one hotel